You've got a few million saved for retirement, but Warren Buffett, the guy who's built one of the greatest investment track records in history, just dumped stocks and stacked 382 billion in cash and treasuries. And that's not a little shift, that's a statement. Because in some ways, it signals that he thinks markets are overvalued and he's not looking to play offense right now. So if one of the world's most renowned investors is getting cautious, I think it's worth asking yourself a simple but powerful question. What would Buffett do if he were in my shoes? And that's exactly what this video is about. We're going to break down Buffett's timeless mindset and apply it directly to your retirement strategy. I'm talking specific tactical moves such as how you position your portfolio and how to start shaping the legacy you'll leave behind. Because in a world of noise, a clear head and a sound plan might just be your biggest advantage. So let's start with that 382 billion. Buffett isn't sitting on that much cash because he's scared or indecisive. He's doing it because he doesn't see compelling opportunities at today's market prices. And that's worth thinking about. So picture this, you're retired with a 3 million portfolio. Maybe you're drawing 120,000 a year to live on and Social Security covers the rest. If I told you to increase your allocation to cash and bonds, even though you don't need that money next week, how does that make you feel? See, for some folks, it feels like stepping backward, like you're bracing for a crash or letting fear dictate your plan. But that's not what this is about. It's about reading the landscape with clear eyes. Right now, US stocks are trading at a forward price to earnings ratio of 22.9. In simple terms, that means on average, investors are paying $22.90 for every $1 of expected earnings over the next year. Now, you might be asking, okay, well, is that a lot or a little? Well, historically, the 30-year average is just over 17. So we're not necessarily in normal territory. We are significantly above it. And when valuations stretch like this, the margin for error gets razor thin. That's one reason, not the only, Buffett isn't buying heavily right now. He's waiting for prices to come in. Now, does that mean he's bearish or hiding under the desk? I would say not at all. He's simply choosing patience, and that's a lesson you can really learn from. So let's make this practical. What does a Buffett-style strategy look like for a retiree who doesn't have a 150 billion net worth? It starts with building what I call a fixed income buffer, or what you might think of as your personal war chest. This is where you set aside 3 to 7 years worth of your spending needs in safe, liquid investments like cash, CDs, or short-term bonds. Let's say you need 120,000 a year from your portfolio. That means you'd want somewhere between 360,000 and 840,000 tucked away in stable assets. It's not earning you gobs of money, but that's the point. It's there to buy you peace of mind and help you weather the storms. And here's why that matters so much. It's called sequence of return risk. See, most retirement projections assume a steady average return, say 6 or 7% annually. But the order in which you get those returns matters even more once you're drawing income. I want to show you a visual from BlackRock that makes this crystal clear. Imagine 3 portfolios, A, B, and C. Each one earns an average annual return of about 7%. During the accumulation phase, when you're working and adding to the portfolio, the order of those returns doesn't make much difference. All 3 portfolios end up with around 5.4 million by age 65. But once withdrawals begin in retirement, everything changes. Portfolio A, which sees strong early returns, ends retirement with about 1.1 million. Portfolio B, with middle of the road returns, finishes around 400,000. But Portfolio C, which suffers weak returns early on, runs out of money entirely before age 90. 3 portfolios, same average return, very different outcomes depending on whether strong or weak returns come early. If you start retirement with a downturn, you might find yourself selling stocks at a loss just to fund everyday expenses. And that can derail your plan permanently. But if you got a war chest, You don't have to touch your stocks in a downturn. You can live off the cash and bonds while your equities recover. So, how do Buffett's adjustments apply to you? I would argue Buffett's cash and treasuries aren't necessarily a retreat, they are a reserve. It gives him the power to act when the time is right. And you can do the same with a war chest as a retiree. Now, you've probably seen the headlines talk of overvaluation, a potential AI bubble, but let's translate that into something useful. A high PE ratio doesn't automatically mean the market's going to crash, but it does mean stocks are more expensive relative to their earnings. That can mean less upside and more sensitivity to disappointment. So if Buffett is pulling back from stocks, does that mean you should follow suit? Not exactly, but it does mean you should be looking under the hood at your specific investments. And that's because not all stocks are created equal. According to JP Morgan, large cap stocks, so think Apple, Microsoft, Nvidia, are trading at forward PE ratios on average around 31.4. And if you're wondering how that compares to a long-term average, we can see that the 20-year forward PE is 19.7 for large cap growth. We are well above historical averages. So maybe you think this is it. This is exactly why Buffett is headed to cash. The stock market is way overvalued. Well, not all areas of the market are. Take small cap value stocks as an example. They are pretty much in line with their 20-year average and historical norms. Not just that, but if you expand your scope beyond the US, you will see that markets outside the US are arguably more favorably priced and not at the same extreme levels as US markets. So what's the big takeaway here? This isn't about fleeing the market. It's about being selective. Because if you followed Buffett for any length of time, you know he's not anti-stock, he's just price sensitive. He wants to own great businesses, but only when they're on sale. So let's say you open your portfolio and you see a heavy tilt toward US large cap growth. All the big names are there. That doesn't mean you need to fire sale everything, but it might be time to rebalance, add some small cap value, increase your international exposure, and yes, hold a little more cash if you're retired. This isn't market timing, it's strategic positioning. When the market gives you a deal, you want to have the capacity and the courage to act. But to do that, you need to be prepared. But even with all this data, you might still be feeling like taking some chips off the table from the biggest names that have done extraordinarily well over the past decade is taking a step backwards into maybe other stocks that haven't done as well recently. After all, Buffett once said, quote, "Our favorite holding period is forever." But let's be honest, that's a lot easier to say when you're not depending on your portfolio to pay the bills. Most retirees can't stomach a 30% drop when your entire portfolio is in stocks or you're relying on it for income, and that's where planning comes in. If you've got your 5-year war chest in place, a market drop doesn't force your hand. You can tap into your safe assets, let equities rebound, and then replenish that war chest when the market recovers. That's how you hold for the long term, not through blind optimism, but through smart preparation. See, March 2020 is a great example. The market dropped 34% in a matter of weeks, but our clients who had that buffer in place were able to stay calm much easier. And because they had their war chest in place, they didn't feel the urgency to sell or make changes, which allowed their portfolios to come back stronger. Combined with tactical rebalancing, it worked very well. Now, of course, past returns are no guarantee of the future, but it's not about having nerves of steel. It's about having a plan that works even when emotions run high. See, Buffett once said, "Predicting rain doesn't count, building the ark does." And in retirement, your ark is the war chest. So tactically, here's how it works. Bucket 1 holds 1 year of spending in money market. Bucket 2 holds 2 to 6 years in high-quality short-term bonds. And Bucket 3 is for long-term growth, your stocks and your growth investments. You periodically and strategically fill up Bucket 1 as it gets spent down from either Bucket 2 or Bucket 3, whichever is performing better. Just like Buffett doesn't make knee-jerk moves based on the latest headline, neither do you. The war chest strategy keeps you anchored. It creates resilience. Let's close with something that matters even more than portfolio allocation. Buffett once said, "When you get to my age, you'll measure your success by how many of the people you want to have love you actually do." And that will hit home for a lot of people. Because at this stage, it's not just about the number on the screen, it's about what the money is for. Maybe it's setting up a family trust. Maybe it's funding education for your grandkids. Or for a lot of our clients, it's about supporting missionaries in their local church and having open, honest conversations with your kids about the future. Buffett's giving most of his fortune to charity, not because he has to, but because it reflects who he is. He knows the money is like dynamite, powerful when used for good, but it can also cause a lot of destruction. And that's the real takeaway. Retirement isn't just a financial event, it's a values event. It's your chance to make sure that what you leave behind truly reflects what matters most. Now, you've just seen how Buffett's caution offers lessons, but what happens when you actually have saved millions and need to make it work? In our next video, we'll step inside a real-life 6 million retirement plan and discover the freedoms, blind spots, and surprisingly tough decisions that come with wealth at that level. You'll learn the critical moves that made this couple's transition into retirement not only secure, but meaningful, from a smarter tax planning strategy to legacy coaching that redefined what their money was really for. My business partner, Anthony, will see you over in that video right now.